Thank you for your attention today. The agenda for the day is quite straightforward. Just give a little bit of a recap and an overview of the fund. It's been a year since we've done one of these webcasts. We'll talk a little bit about 2023, review the year. What's the portfolio positioning right now, key themes in the portfolio. One of them is what's going on in Korea, which is quite exciting and where we are well positioned. So we want to do a little bit of a deep dive on what we are seeing in Korea. But first, the things that haven't changed, that's the team. It's still myself and Katrine Geter and Espen Klette. We've been working together now for the last 5 years, with Espen having joined us in January 2019. So great to see the stability in the team and the results that we're delivering over time. So for anyone who has any questions about the team, feel free to ask questions, but given there's been no change, we won't dwell on it. Also not changed very much is our investment philosophy. It's been the same since the inception of the fund. It is, however, worth spending a little bit more time on that, just recapping what is it that we believe in and how do we manage the fund. We're bottom-up stock pickers. We make full use of the unconstrained global mandate that we have, with a focus on global emerging markets. I think it's worth bearing in mind that when we say we have an absolute return mindset, it means we invest where we see the greatest upside relative to the risk that we take. We do not define risk as, where other people are invested or what the index may look like, because that changes with time. Instead, we use our long-term investment horizon, typically minimum 3 to 5 years, but we also have a number of holdings in the portfolio that have been there for a decade or more. As long-term investors, it does mean that ESG and sustainability have to be an integrated part of the investment process. The longer your holding period is, the more important the fundamental drivers of the company and the sustainability of business models become. This has always been at the heart of the way that SKAGEN manages its equity portfolio. And then I think finally, and the most difficult one, is contrarian mindset. Again, if you're going to go where you see the greatest upside value and your compass is valuation and low starting points, then you are not necessarily spending your time where everyone else is, because the chances of finding those beaten down stocks with the greatest upside potential and the downside protection is harder in those more competitive markets. And I think if I were to summarize it, the 3 things that we want you to take away from our investment strategy is that we're value-based, we're long-term, and we're contrarian. And we like to show that we fulfill those expectations. So number 1 is on the value-based. In the middle of the chart, you can see how our valuations stack up against the index. So both on trailing earnings and on price to book, we are trading at a pretty much a 50% discount, so half the price of the market. The way that we're able to do that is to think differently. An active share close to 90% means that we are really in other parts of the market than what is in the index. And you can see also here on the right-hand side, the composition of the fund. It does skew, at least relative to the average competitor in the emerging market space, much more to small and mid-cap companies. Again, those are often companies that are flying under the radar, or where people spend less time finding those future gems. So that's how we try and differentiate ourselves. What is it that we're trying to achieve in the portfolio? If I was to say it in one way, is we seek value for money. Now, the way that we show that is through the Morningstar data. We try and get the same for less. So again, as a value-based manager, you would expect us on the valuation characteristic or the style factor for us to screen low. Here in the blue dot is SKAGEN Kon-Tiki. In the black line is the category average, significant discount to the market. But what might surprise you is that that is not at the expense of quality. So when you look at the quality factor, be it return on assets or the stability of earnings evolution, we are more or less trading in line with the market. So again, if you can get the same characteristics for a much lower price, we think that's an attractive starting point. Here we've just taken the same data from Morningstar, just on any kind of valuation metric you would choose, be it price to earnings, or price to book, price to sales, price to cash flow. The portfolio is trading at a discount between 40 and 60% without making any major sacrifices in terms of quality. So over time, we think that that gives you the starting point for delivering good relative returns. Now, many of you will know that the emerging markets have had a fallow period over the last 10 years. Absolute returns have been weak, but when you see the relative returns before fees, we've had very, very strong relative results since the team came together. And even in our retail share class, which is the one with the highest fees, we have delivered competitive relative returns. So again, I think that in challenging markets, the best way to differentiate yourself and protect yourself has been through the strict application of our investment philosophy. So that's the fund. What happened in 2023? What were the things that we would highlight? Well, firstly, I think 2023 was pretty much a reversal of 2022. So when I sat here and spoke about 2022, I said that real assets had done really well and the overvalued US market driven by the tech sector had underperformed. And what happened in 2023? Real assets did poorly, and equities led by the US market and especially the tech sector had a stellar year, and that has continued into 2024. Disappointingly for us, EM equities were at the lower end of returns within the equity market, but still a decent positive return in a historical context. And as I mentioned earlier, we were able to deliver a little bit of outperformance beyond that. If we dig into the markets, here you can see the emerging markets versus the all country world index. But I think, you know, again, as is the case in every year where I've been working at SKAGEN, you've had a big divergence from the losers to the winners in any given year. China, if we start with the weakest market, did clearly have a weak reopening from COVID, and also the general economic weakness, especially driven by the real estate market, has weighed on that market. On the other hand, within emerging markets, Brazil, where we've had good exposure over the last couple of years, and we still have, was a very, very strong market, partly as you started seeing monetary easing, which we think has further to run, but also because you've had a good development in a number of the key operating companies. Taiwan was also strong. I mentioned earlier the tech sector, where obviously Taiwan is a strong supplier country. And you may recall that during the autumn of 2022, we actually invested in Taiwan Semiconductor for the first time. And that meant that we also benefited from the rally in Taiwanese stocks. If you go into the portfolio or at the fund level, you may be surprised, given what I've said, that two of our top 5 contributors for the year were Chinese companies. Again, it was the energy company CNOOC was our top contributor. It has been so every single year since we bought it in 2021. The company continues to deliver very strong operations, but also the shareholder return profile is very, very strong as cash flow is returned to shareholders. Also, Foxconn Industrial Internet, it's a subsidiary of Taiwan-listed Honhai, which many of you will know as the manufacturer of iPhones for Apple. What's interesting with Foxconn Industrial Internet is that it houses many of the biggest growth areas of the company, both related to artificial intelligence and related to the rollout of 5G. And we were able to ride that excitement at the start of 2023 and take profits early in the year. Interestingly, we have re-entered the stock in the second half of 2023, but as the Chinese market weakness weighed on it. Second country I highlight is in Korea. We've been invested in Korea for a long time. We want to talk about it again, but there we had good recovery, especially in Hyundai Motor, where both sales and margins have been well above expectations for some time now. And also in Samsung Electronics, the expectation of recovery in the semi-cycle has clearly also driven that stock. Also think it's worth highlighting, it is a stock picking portfolio. So yes, you'd expect our Brazilian holdings to do well. Banco do Brasil has delivered superb operations ever since we invested in the company, delivering return on equity now in excess of 20%, trading at just 1x book. However, in such a strong market, we did have one of our weaker contributors in the retailer Asai, which has been hit by weaker consumption, but also higher interest costs because of its leverage. Also saw some company-specific weakness in India at crop protection company UPL, where the agri cycle is clearly in a down cycle at the moment, which has hurt the company, and also at South African gold and PGM miner Sibanye-Stillwater, where there have also been operational challenges and a dilutive capital raise. Finally, just mentioning Ping An, which is one of our largest Chinese holdings, did suffer in line with the Chinese market. But I think, again, the summary for the fund holdings and top and bottom contributors is that even in challenging markets, it is possible to have strong performers. And unfortunately, in some strong markets, there will also be some stocks that do less well. So it is also about the stock picking. And if I delve into that in terms of the stock picking, I think it's worth just giving a little bit more detail on China, because it is a market where we have been net buyers since 2021. So we have been increasing our exposure as the market has weakened. But you can see here that we have navigated it relatively well. So in euro terms, the portfolio delivered net of all fees 8% return last year versus 6% for the benchmark. Our holdings in China also delivered a positive return, admittedly not as high as the rest of the portfolio, but that was in a market which fell 14% in euro terms. So we had a significant amount of relative outperformance within China last year. And that's not a new thing. That's also been the case for the last 3 years. Here, the fund returns in euro have been weak over the last 3 years. We've seen that from general weakness in the market. But actually, our Chinese part of the portfolio has delivered more or less break even, again, in a market that has fallen by more than 15% per year over those last 3 years. So it's interesting that the weakest market that we operate in over the last 3 years, our holdings there have actually been accretive to both the absolute and the relative returns of the fund. And it shows the importance of stock picking and using our value-based investment philosophy to limit the downside in challenging markets. So how are we positioned right now? I think there are 3 key themes in the portfolio right now that, what they have in common is low valuation as a starting point, but they have very, very different drivers for repricing in our view. Together, China, Hong Kong, Korea, and Brazil account for approximately 70% of the portfolio. So this is really what will drive the returns for 2024 and possibly longer. First, in China, I think any kind of stabilization in China will be taken well. When I look at fund data, global funds have massively reduced their exposure to China, and valuations are near all-time lows. What we're seeing now is that the authorities have woken up to this, and we do expect more supportive measures to come out. It's also interesting to see that the securities regulator has had a new boss of the regulatory department announced. We also expect Korea to do well. Here we are seeing significant reforms driven by government intervention in what they call the Value Up program. We have quite a weighty overweight in Korea with 25% of the fund invested here, and we'll go into more details why we think that that's appropriate. And then finally, I mentioned that Brazil had been very, very strong in 2023. We benefited from that. We think there is much more to go for also in Brazil. The broad market is trading on just 8x earnings, and you have a significant opportunity to build a diversified portfolio within Brazil across the agri space, across consumer, and across commodity exporters. And we think that the setup with continued monetary policy easing is very, very conducive to equity returns. So what have we done in the portfolio during the last year to get to this kind of positioning? I think, you know, it's important for us to show that our active management of the portfolio is quite regular. We have a turnover ratio in the portfolio of around 30%. That's in line with our 3 to 5 year holding period. So given we have 45 stocks in the portfolio right now, you should expect 6 to 10 changes either way during the course of the year. And in that regard, 2023 was a pretty normal year. I think what I would highlight here is that at the start of the year, we actually sold 2 of our longer term Chinese holdings. That's because they rallied strongly at the start of 2023, reached our target prices, and in line with our disciplined valuation approach, we actually were able to exit those companies before the drawdown in the market as the disappointment from the COVID reopening came through. The other thing worth highlighting is that, as many of you will know, we had 5 holdings in Russia when they invaded the Ukraine in 2022. We were locked into those and they were written down to 0 when that happened. But in line with our previous communication, we've been working behind the scene and we've been able to exit 2 of those holdings. One doing an over-the-counter transaction with X5 in London, and also Magnet. Both of these are food retailers which bought back its own shares. So we were able to salvage some of the value in the Russian market. The other changes in the fund during the year in terms of selling was mainly smaller adjustments to the portfolio and also taking profit at Kinenco and Ivanhoe Mines as they hit our target prices. We've spoken at length about Ivanhoe Mines in the past. We've been shareholders since 2018, and the stock had returned about 6 times our initial investment on that. So we were very happy with that long-term investment. In terms of new stocks, in the interest of time, I will just mention 2 of them, but we can talk about more if there are questions. One is after our visit to Brazil in January 2023, we invested in the transports and logistics conglomerate Simpar, which was one of the findings from the trip. And we had also invested in another Korean bank, KB Financial, early last year because we were starting already then to see some of the positive changes that we will talk about later. So where does that leave the top 12? Well, since our review last year, there have been 3 changes in the top 12, but only one of them is a new holding, which is KB Financial. SKAGEN and Banco do Brasil are 2 of our larger Brazilian holdings, where we increased our position of SKAGEN after our visit to the company in January last year. We were able to do a block transaction there, and also because of the stellar returns that Banco do Brasil have yielded since we invested in it, that has become a bigger position over time. And as you can see from the valuation at 4.5 times price to earnings and 1 times book value, we think that there is still more to go given the return profile of the company. I think rather than go through line by line with each company, it's worth again just to stress the valuation characteristics of the portfolio. If you look at the 35 largest holdings, which account for most of the portfolio, it's trading at a close to 50% discount to the market. And even if we were to realize the upside potential in our holdings that our fundamental research has led us to, it would, at our target prices, so if everything in the portfolio went right and we got the valuations that we think are appropriate, we would still be trading at a slight discount to the market. So again, when you look at the characteristics of the portfolio with the same kind of ROE characteristics, a better cash return profile, we don't think it is crazy to think that our holdings could re-rate to trade more or less in line with the overall market. Right, so a little bit on Korea, because we think it's exciting and timely at the moment. Why is Korea interesting? Why have we always had a large weighting in Korea? The simple answer is that on most quantitative measures, it looks cheap. Actually, it's probably the cheapest large equity market we look at, and therefore we have historically had a significant exposure to it. Now, it's important to think, why is Korea cheap? And historically, that's been to generally poor corporate governance, or at least a perception of it, and also much weaker minority protection, especially in the larger family-controlled conglomerates. Now, the reason SKAGEN Kon-Tiki and the other SKAGEN funds have been successfully investing in Korea for more than 20 years is that we've been able to pick out those companies where there are either better behavior or there are positive changes afoot. So we are not buying into these companies just because they're cheap. They have to pass our quality considerations first, and we relate that to the price that we pay. So we have already been through successful changes in some of our holdings there, for example, the LG group of companies, and we now see further signs of regular driven improvements in the market, especially in the financial sector, which we think can lift the market further. Whereas if I echo my colleague Jonas Edholm on the Focus Fund, one example here is that Korean banks are absurdly cheap. So if you look at the banking sector, you can see that Korean banks at 0.4 times price to book are trading at the same distressed levels as Chinese state-owned banks. Now, I think very, very few people are as uncomfortable or should be as uncomfortable owning a Korean bank as being a co-investor in a state-owned lender, where maybe the corporate governance is not favoring minority investor. So what's also interesting is that Korean banks trade at roughly half the price of Japanese banks and only a fraction of larger banking systems like India and the US. So before I look into what's changing in Korea, I just want to show you a little bit of what has happened in Japan over the last 1.5 to 2 years, where our colleagues in SKAGEN Focus have been invested. So there's been a material change in the relationship to the financial markets in Japan. And we are seeing here from article in the FT that there is explicit and public pressure on companies to achieve a fairer pricing of their equity. This kind of name and shame regime pressures companies to explain why they think that their stock is so cheap, and more importantly, what they will do to close the gap, at least to get to the book value of equity. And the results have been impressive. Here in red, you can see that the Nikkei index has been trading more or less in tandem with the Kospi, which is the Korean index, up until about 18 months ago, where you've had a significant rally in Japanese equities compared to what we've seen in Korea. And if we look at the banks as an example, here in green, you can see the price to book ratio of the Japanese banks, and in white, you have the Korean banks. And up until that same period, 18 months ago, they were trading pretty much in tandem when Japanese banks started re-rating massively. And what's interesting is that those Japanese banks, even though they've gone up a lot in pricing, are still earning lower returns on their equity than their Korean counterparties. So this is a good example where we think that you can get more than you pay for, especially if positive change is coming. And I took part in a big investor call a couple of weeks ago, and one of the phrases that stuck in my head then is when one of the Koreans said, "There's nothing Koreans hate more than seeing Japan doing something better than them." So what are they doing to catch up with the Japanese? So on the 24th of January, the Yoon government announced or proposed a value up program, and it is very similar to what we saw come out of Japan. You have to answer, why is your company's stock so lowly valued? What are you going to do to change it? And if you do, you will have our support in order to get this run through. And I think this is important because historically the government has not been seen to be supportive or encouraging, especially the banks, to focus on the valuation. Instead, they have encouraged the banks to build capital buffers, in our view, sometimes excessive capital buffers, and been more sort of a counter-cyclical tool rather than focused on shareholder returns. So why are they changing now? I think partly it's because more people care. In this chart, in the yellow bars, you see the number of Koreans who are investors or own equity, And there's been an explosion in the number of equity holders in Korea over the last 4 years. It's more than doubled to over 14 million, which means that you have almost as many investors in Korea as you have homeowners. So with an election coming up later this year, and a third of the population at least are investors, I think this is now more important than it has been historically. And we're seeing it through other channels as well, where public support is building. So the Korean Corporate Governance Forum, which is an interest forum, they are also writing papers and giving presentations linking how low valuations of Korean stocks yield low returns on Korean savings and their investments, and therefore hamper capital raising opportunities, and that these absurdly low valuations therefore have a negative impact on the long-term competitiveness and the financial returns of Korean people. And what we're also seeing is that these kind of public statements and campaigns are also supported by local activist investors, such as Align Partners, who we at SKAGEN have supported in their work behind the scenes to increase shareholder returns at Korean banks. And I think this is a good example where we show how we do active ownership in practice. We are meeting with the companies, we are meeting with other like-minded investors, and we are working for improved governance and shareholder returns on behalf of our unit holders. This work will continue next week when our Chief Investment Officer, Alexander Morris, and our Head of ESG, Sondre Myhre, will again head to Korea to continue the dialogue with our Korean holdings on behalf of both Kon-Tiki Fund and the other SKAGEN funds who are invested in Korea. So these are really, really exciting times in our view. So bringing it back to the Kon-Tiki portfolio, again, I think, we have roughly a quarter of the portfolio invested in Korea. It's a good mixture across 11 companies between global kind of well-known brands and export champions that we have held for 10, 15, 20 years. But there are also companies in there like KB Financial or like DGB Financial, which are newer additions to the fund, where the drivers of a potential upside is much more driven by changes in society in Korea and what is happening in terms of shareholder returns and where we can play a role. And then just to show that we still do our craft in Korea in the same way that we do elsewhere, here we've got a chart showing the price to book value on the x-axis, the price to earnings on the y-axis. So basically, the closer you are to the bottom left, the lower the cheaper you are, and vice versa. The closer you are to the top right, the more expensively you are valued. And as you can see, Korea is trading at a discount to broader emerging markets, and the vast majority of our Korean holdings are again trading at a big discount, even to the cheap Korean market. And this is important not just because of that's how we invest, but it's also important because what we think is going to happen. So again, if we look to Japan, there are important lessons here. So over the last 12 months, there is a clear correlation between the starting valuation point and the returns that you have achieved as the Japanese market has gone through this change. So if you were buying stocks trading at less than 0.5 times book a year ago, you would have made 40%, 0.5 to 1 times, so basically still undervalued relative to the equity base, you would have made roughly 130. And basically, the more you paid at the starting point, the less return you have made. And this actually makes sense because these are companies that are more likely to be exposed to change. They have been lowly valued because people have given up on them. So that's where the biggest delta is. And since the launch of the Value Up program in Korea, we have started to see similar trends within our portfolio companies in Korea. So, the Korean index in won terms has only given a 6% return in that period. It's a little bit better than the EM index at 2%. But what you have seen is that those companies that we own that were bottom left in that valuation quadrant have yielded vastly superior returns to those that were higher up to the top right-hand corner. So Hyundai Motor alone has gone up by more than 40% since 24th of January, and KB Financial almost 30%. So again, the way we are positioned in Korea reflects our approach to investing. We have a good valuation starting point, and we want to position ourselves for change, and we think that this change is now in motion, and given where valuations still are, we think that this will continue to be a positive tailwind for the fund. So then, just to summarize, there's no change to who we are and how we do our business. We are an actively managed global emerging markets fund for long-term investors. We have a very, very clear value-based investment philosophy that we've communicated consistently over and over, focusing on those long-term sustainable returns. We are very happy to hold our best companies for the very, very long time, but we are also disciplined in terms of selling out when things are changing for the worse, or we have made our expected return. We have built a portfolio which is concentrated. You saw that top 35 holdings account for 93% of the fund, but it is balanced across sectors, across countries. The only common thread in our portfolio is that on our independent fundamental analysis across various scenarios, we think each holding is undervalued on its own merit, and that means that we are often fishing in the most unpopular of places. But obviously what we want to see is some element of stabilization or change. And we think that the three markets where we are the most significantly positioned for 2024 meet those criteria, where the example in Korea, I think, is one that is most timely at the moment.